Andrew Slimmon joining us here on the big program, Senior Portfolio Manager and Head of Applied Equity Advisors over at Morgan Stanley Investment Management. And Andrew, I think this really is the question here. I mean, we have stocks more or less at record highs with the S&P, the Dow, and the NASDAQ hovering there. And everyone really kind of wants to know, I mean, is there a catalyst out there that could sort of materially move this market higher? Or is this pretty much it? I mean, we got our gains for the year. Should we just be happy and walk away?
Sure. I mean, I'm certainly happy on the year so far, but I think the catalyst is really, number one, the capitulation of the more bearish views coming from Wall Street. But what has not capitulated yet is all that money sitting in the money market. It's my view that the reason why there's so much money sitting in money markets is because of the perception that 5 to 6% of the money market is a very attractive return. That is a classic case symptomatic of early stage of a bull market when people have very low expectations. The later stages of a bull market, people expect higher returns, and 5 to 6% is not very attractive. So I think the fuel to keep the market, at least for now, pushing higher is really the money that comes off the sidelines. And that's, classic fear to greed cycle. And to me, it just says we're still in the fear stage. Well, it gets to a question then. I mean, you talk about that being the fuel, but sort of what opens that spigot here? I mean, if people are looking at the, 4 to 5, maybe even 6% that they might be getting, and they don't think that they can find anything comparable, at least on a risk-adjusted basis, what changes their view? Is it just further gains in the stock market and it becomes a FOMO or a drop in yields where they just aren't getting the same returns? What? Not dropping yields. FOMO, 100% FOMO. The market's up 20% last year. If we keep going higher, it's the FOMO. I am completely convinced that the only thing that's going to get people off the sidelines is ever higher returns for stocks. Doesn't mean we can't have, pullbacks along the way. I think there's one coming this summer, but I think that is the fuel to keep this market pushing higher. And basically what you're having is you have a situation where earnings are coming in strong and the inflation prints continue to come down. So that justifies people saying, well, maybe I should get a little bit more optimistic.
It definitely feels like that would lead to some serious blow off top, though, if you wind up seeing all that money market funds flow into the equity market. What's a good way to play that? I mean, do you need to look at options as a way to play that upside? How do you deal with it?
Well, I don't think it's all going to come in, Alex. I don't think it's all going to come in at once. Everyone has a different, kind of fear to greed monitor. But I think it goes back to the original question: what is going to drive it? And I still think that there are plenty of stocks out there that are pretty reasonably priced, especially on the financials being one. So as people search around for areas that have kind of lagged, I think the cyclical still will attract more money because I haven't seen, other than a little consumer weakness, I just don't see the economy really slowing down. The market's screaming that. Metals and mining are doing well. You've got a lot of the cyclical stocks that are semis are doing well. I mean, these are groups that wouldn't be hitting highs if the economy was about to roll. Credit spreads are tight. So I think that's the area people are going to buy into.
Okay, so you like cyclicals, you were mentioning semis, so that's a growth play. Where's the valuation with the growth play?
Well, look, what's happened in the last month or so is that we got a good, obviously we've had some good inflation prints. And so now the market has pivoted to Fed can cut, rates are coming down, and that's kind of spurred the growth over kind of value trade recently. I think when we get to the summer, I think the inflation prints are going to get tougher to show better comparisons. And maybe that's when the market starts to say, maybe the Fed is not going to be cutting. And that's when you get a little pivot back into the value names, again, assuming the economy stays strong. Versus growth.
I am curious. I mean, what type of names do you find attractive right now, Andrew? Because we talk about this idea that for those folks that are invested, want to stay invested, or are looking for an entry point, there's still this crowding that we continue to see around the big cap tech stocks, even though I know there has been a little bit of a pull into some of those value names, into some of those cyclical names. Are you part of that group?
Yeah, so like, for instance, the insurance, we like Progressive. Well, Progressive is a company that actually likes higher interest rates. So as rates have come down a little bit recently, they pivot into the growth, that has underperformed, although just recently, their business is very strong. I think the asset management, wealth management business is very attractive. So a stock like Ameriprise, for what we just discussed, which is, as money comes out of the money markets, it's going to go into higher returning assets. That's good for the wealth management industry. And then a third area that I think is following fiscal spending. Where is the government spending the money? Infrastructure. You look at these big industrials that are tied to infrastructure. So CRH is a cement company. They're raising prices. The government is taking those price increases. So I think there's plenty of reason. I'm not saying, hey, avoid tech. I'm just saying there are other areas that are doing well beyond just the AI tech trade.